All right, folks, welcome back to the Property Couch podcast. And today is a very exciting episode that we're bringing you. It is the September quarter property market update, and we're going to tell you what you need to pay attention to and what trends you need to look out for. What else do we cover, Ben?
Well, Bryce, we're going deep into the data. So we're going to be looking at, in terms of the value story, what's the capital growth drivers? We're going to look at demand and supply. We're going to go deep in some of those metrics and variables. And finally, we're going to turn our attention to the yield and the income as part of that story. So we're going deep on the data today, Bryce.
You heard it from Ben, folks. We are going deep. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance, and money management.
All right, folks, welcome back to the Property Couch podcast. And of course, welcome back to you too, Ben. How are you?
Mate, I'm well, but what a fizzer.
I know.
What a fizzer of a GF.
I know.
I think we should just move on. Let's congratulate Brisbane, worthy winners.
Yeah.
Coming from fifth, it was a good run.
Yeah.
But we'd like a good grand final.
Mate, I lived in Queensland in 2002, so I got to experience the Brisbane energy that was when they got their three-peat, which was a lot of fun, and it was nice to see them win on the weekend. But gosh, if only we could have grand final. The only bad thing about last year's grand final is you guys won it, but the fact that it was a 4-point decider makes it so interesting for
it does
so much longer. But it's on again next year, folks, and I think for a lot of our regular listeners, they look forward to this week, Ben, because then pretty much between now and March, we don't bang on about it. So it's
unless there's a really good trade scoop, but other than that, we'll move on.
Exactly. Hey, we're going live next week, Ben.
We are.
I'll get you to talk about what we're going to talk about shortly, but just to set the scene. So next Wednesday at 1:30 p.m, you and I are going to do an episode of the podcast live, Ben, on Facebook, YouTube, and the Property Couch websites. Bringing back the days. Remember we did it live in front of 400 people in Melbourne? We're now doing it across the web, but behind the scenes, got to ask some questions. But what are we going to talk about, Ben?
Yeah, so obviously negative gearing and capital gains tax concessions are in the news at the moment, given the Treasurer, Jim Chalmers, has asked Treasury to run the numbers to see whether negative gearing needs to be adjusted in this country. We're here again, Bryce. We're here again. It doesn't seem to go away. So what we want to do is we want to tell a story around the whole backstory of negative gearing. We're going to take a deep dive into some of the concepts, but we're also going to be talking about some of the commentary that comes out from both economists and then some of the journalists or people who write opinion pieces out in the marketplace through the media. And we're going to sort of debunk some of those myths. We're going to talk honestly about the potential impacts associated with those. So it will be a significant deep dive. And so it will be something that we hope that then will be shared around so people can be more informed about the debate that is negative gearing and also capital gains tax concessions, because there's a lot of misinformation out there. So we're going to put all of that data together with some of the latest data that we have available to ourselves as well, because we obviously did this in 2016 and then we came back for it again in 2019, and here we are in 2024 with a potential election. And so we can't really trust the government in regards to them not changing their mind. They've come out, obviously the Prime Minister has come out and said that we're not going to necessarily touch it unless we can prove that it's going to do something for supply. But they also said they weren't going to change stage 3 tax cuts. So, that could be part of their strategy, because the ultimate story here is that they'll do whatever they need to do to get back into power to have a second term of government. And so if they're, sort of bean counters behind the scenes work out that it's going to be a net positive for votes to hold enough seats, they will potentially do it because they'll be interested in basically their judgment call will be a means to an end, which means that even if it mightn't be a great thing to do, if that gives them another term of government, they will do it. So that's why we want to make sure that it's very clear to everyone in terms of the potential impacts, Bryce.
So stick around for that, folks. Make sure you check it out. So to Ben's point, we're going to talk about the history of negative gearing all the way back to the 20s. We're going to talk about what some of the people, the experts at the coalface, are going to, what their feedback is around that. And clearly Ben is going to front on address any of the remarks that people are making. It's kind of it's almost the Donald Trump fact checks that you'll be doing, Ben, where you whatever's coming out of these journalist mouths, you're going to fact check them.
Don't put me in the same conversation with Donald Trump, please.
Well, mate, you don't have to like the person, but you can see that he gets stuff done sometimes. So
he does. That is true.
We'll put you in that camp where you just get stuff done. But so, folks, check that out. We'd love you to be a part of that with us next week, ideally live. All the best to our team, Ben, because it's pretty easy for you and I just to turn up and go live, but for them, there's a whole bunch of stress that comes with it. Hey, my mindset minute theme today, Ben, is from someone that I follow. His name's Brian Feroldi. He educates people on what to look for in companies. He's got this this quote that I feel like is representative of a reflection of what we talk about over many, many, many years. But it says this: the stock market is either 1, a gambling machine, or 2, a reliable wealth creation machine. And the only difference between 1 and 2 is your holding period. So it's kind of that voting machine versus the weighing machine, another way to say it, Ben. But I figured the reason I put that in is because it's gonna lead into what we're chatting about today. But you could substitute that out and put the property market in there. The property market is either a gambling machine or a reliable wealth creation machine. The only difference is being, your holding period. It's kind of talks to Charlie Munger. You don't make the money when you buy. You don't make the money when you sell. You make the money in the hold. So again, it's just playing into a bit of a theme that we're talking about today. So there you go, folks. Ponder that, whether or not you have the view. Ideally, it's a long-term view, so it can be a reliable wealth creation machine. Hey, Al, what we're going to talk about today, Ben, is kind of a follow-on for what you and Evan did last week, and it's something that we will do routinely next year as well. Is we'll have a look at the data as it pertains to the property market. And give our audience an update on what that looks like based on our own internal data, Ben, obviously some external data that we get from our good friends at CoreLogic, and ideally give people a bit of a look into what is arguably the last decent look that we'll have before we turn for the new year, Ben, given that there's still a couple of board meetings. The next one's only 4 weeks away. It's debatable whether there's going to be much more meaningful data in the next 4 weeks. But we really want to give people what we think is an opportunity, a look at an opportunity. If you have the ability to look over the hill and look around the corner, Ben, and see what's coming, we feel like today is really going to set that up. But property market update, Ben, you're excited about that?
But I'm always excited about it because at the end of the day, we're very privileged to have an enormous amount of data. Like we've got, tens of millions of data points. We're collecting new data points and we're all obviously trying to ascertain the trends in the market. And what we want to try and do today, and every time Bryce and I now do these property market updates throughout the course of the year, and we'll probably do, around 6 of them each year, is to just try and curate what we're seeing in the data and pass that information on. I mean, ultimately, our foundational principles that Bryce and I talk about for the last 500 plus shows haven't changed much. I mean, you could probably say they've changed maybe 5% over that time. So what this allows us to do is to sort of then talk to, okay, what's happening in the market right now? And what can we see in those trends? And teach people to sort of start thinking about the medium to longer term trend lines as opposed to, what was yesterday's news. And so that's what we're hoping to do, is to teach you to be a bit more analytical in your thinking, a bit more data driven in terms of how you're making some of those decisions. Now, we're still going to stay in that sort of macro and sub-macro level. So 30,000 coming down to 10,000 foot views. We're not necessarily going to go down into the suburb by suburb assessment of that. Because again, we've said this very, very early on in a podcast. We do that for our clients, the people who pay us for that work, but we are going to guide you into markets and commentate on markets, so you'll get a good sense of where each of the broader markets are at across Australia. And I think hopefully that will help you. And we obviously get to enjoy doing this because we're in the data on a week-to-week basis in terms of what we're doing about new areas that we're selecting to buy in, and then what we're thinking about in the short, medium, and longer term as part of our strategies.
So in summary, Ben, the results for the end of September, the headline would be that there's a bit of momentum that's leaving the market. So that's kind of the broad assessment of that. But 4 capital cities recorded a fall in the dwelling values through that September quarter, and it was led by Melbourne, where values were down 1.1. Canberra, Hobart, and Darwin also recorded declines in the quarter. But then you've got the mid cities, the mid-tier cities of Perth, Adelaide, and Brisbane, because Perth was up 4.7, Adelaide was up 4%, and Brisbane, although it eased back a little bit, it was still up 2.7%. So an overall nationally for the quarter at 1%, but you can see you've got some that are up, some that are down, and some that are sort of tracking. Interestingly, Sydney at 0.5%, which would suggest that particular market it's currently at peak and might be starting to have a little bit of momentum running out of that one too.
Yeah, I think that's part of our broader theme that we are talking about, and that is that the momentum in the market, the interest rate restrictions, the cost of living, the forced slowing down of that economic flywheel in the economy is starting to show up now in the property space. So, at the start of the year, we were quite bullish on a mid-year cash rate change, but the economy has actually performed better based on the government spending into, reliable jobs in the sort of education, health, aged care. And so we still have this very, very strong employment story, and that has meant that businesses have been able to continue to keep sort of charging that because the consumer's been active. Couple that with obviously the population growth that's also happened in terms of that population story. So the economy's performed better, and that's meant that the inflation story has taken a little bit longer, and that's what we're seeing here now. But we're starting to, the momentum and the absorption that we're seeing in those particular markets is definitely changing. So if we go down and have a look at some of those past performances, so thank you, Bryce, for doing the capital cities. Let's now break down and have a look at some of those regional centres, and we can see that, again, we're looking at that sort of 3 month. That's where we want to sort of see what's happening. And so we can see Tassie's down negative 0.2, regional WA, regional South Australia, regional Queensland. That has very much been a ripple effect and a sentiment and confidence story for what we would call the retail investor, the mum and dad investor who's potentially looking for affordable locations. It's probably also driven by a lot of commentators in this property space and buyers agents who are looking for those affordable markets because, their clients are limited by their borrowing power. And so that's continuing to chase that 400 to 600,000 price band. And when they're not available in the capital cities, we are starting to see some of that, sort of driven into those sort of regional areas. And you've got to also acknowledge that the Western Australian economy is running very well. South Australian economy is also doing quite well, and same for the Queensland economy, more broadly. Now, one thing that is happening in Queensland is there's more than likely to be a change of government. Certainly that, the Labor government that's been in place for a long period of time has, upset enough people now that they're looking for a fresh set of eyes and ears in terms of how they're going to look at their broader economy. Then you can see regional Victoria is underperforming, negative 1.4. I suspect that, we've talked about this as a combination of, a lot of people move to the regions with the very, very strict lockdowns we had here in Melbourne. And so that might be just people readjusting their situations in terms of what's happening in the regions. And you've got, also silly decisions by government in terms of, Airbnb and stays accommodation and all of that. So that's going to restrict potential people movement in terms of interest rate tourism and sort of those types of things. So the Victorian economy, we know that unemployment's growing here faster than anywhere else in the country. So that hasn't sort of sat well with that. And then you've got regional New South Wales, which is still scratching out some growth as well. So even though it's cooling, we're still seeing some of those markets achieving growth, and that's also part of that affordability story as we look at those particular stats, Bryce.
And there's definitely a correlation too, isn't it? Because you see the biggest regional performers are also linked to the biggest capital city performers. And I guess the cautionary tale there for investors is just to think sort of medium term around that too, because it wasn't that long ago that regional Victoria was very positive in terms of that growth.
Very positive.
Yeah, Melbourne going, and then it definitely is linked to the big brother, the big sister of the bigger capital cities. But I guess as we move to have a little bit more of a deeper dive, one of the things that's interesting, and for those watching on YouTube or on Spotify, you'll see the charts here. We'll try and describe it in audio as best we can. But what's interesting about quarterly changes in the hedonic dwelling index is there's a very strong bias towards the lowest quartile, the bottom 25% quartile. And largely, it kind of makes sense too if you think about it, particularly in Brisbane, Adelaide and Perth where they are strongest, because you've got a banking system that has really pigeonholed people into these particular markets, largely because affordability or borrowing capacity suggests that I've only got this. Even if I have a desire to spend more than this X amount, I've only got this amount. So therefore, you're looking around the country. We've been doing that as a business, looking around the country for opportunities. And what I find fascinating, Ben, is I grew up in Perth. The very first house I lived in was in the southern part of Perth. It was in a shire of Kwinana. The first house I ever lived in was in a suburb called Aurelia. And that was a long, long way from the city, Ben. There was a freeway that came through, but it was probably more on the lower demographic than other parts of Perth. But that particular region, Ben, if you have a look at the latest data, has performed significantly over the last little bit. And if you think about what it is, it's because the price point allowed a lot of people in that market who wanted to buy at an entry level, if they were buying it with shelter as the main purpose. Well, clearly there was an affordability play that they could get into, Ben. But then when you think about some of the East Coast investors that were coming over who were also limited by borrowing capacity, it kind of made sense that these particular markets started to grow. So you can see that in Brisbane, Adelaide and Perth here, and just marginally Sydney, you can see that the growth was greatest in that bottom lowest quartile.
Yeah, so thanks to our good friends at CoreLogic who provide this quartile data, and Tim Lawless, a great friend of the pod. We did see that over this sort of period of time, 12.4% of that lower 25th quartile, that's the growth we saw over the quarter compared to the upper 75%, which is obviously the more expensive properties. We only saw a 3.8% growth. So for those new to the game, what normally happens is in a classic typical cycle, we see usually the more expensive markets leading the way, and then a ripple effect happening. So as a market finds its feet and it goes in through a capital growth cycle, it's usually that top quartile that starts to grow first. Then it ripples down as that sort of affordability and judgment calls are being made by consumers in terms of that whole sentiment and how they're going, and then ultimately what they can afford to buy. And so Melbourne, if you look at the current chart that we've got on screen, you can see it's in a classic down cycle, which is, you can see there, negative 1.8% for that 75th quartile. For the mid quartile, negative 8%. And then sort of for the bottom quartile, you're seeing a negative 0.1 of 1%. Now, if you then look at the Brisbane and the Adelaides and the Perth, which to Bryce's point are the moving markets, you can also see that these markets are in a cooling phase. Because if that was true about the uplift, then normally what you'll find is the top 25% quartile is leading the charge, then the mid, then the low. And so what we're seeing now is that momentum is slowing down in those particular markets. And that's what we talked about earlier in terms of, this spring selling season and talking to agents and getting that commentary and looking at our data. It's very, very clear that the supply side, which we'll talk about soon, has started to outstrip that level of demand. So we aren't seeing that same level of absorption. But when we go into a bit of a deeper dive shortly, we'll start to see how that's actually looking in our data sets when we talk about the market in general.
But if we talk about where the markets are in terms of historically, Ben, Sydney is at its peak. Brisbane, Adelaide, and Perth are at their peaks. Melbourne's peak was back in March of 22, so that's off 5.1%. Hobart also back in March 22, that's off 12.5%. Darwin's peak was some time ago, Ben, a decade ago, and that's at 6%. You have that as a smoky. And Canberra, a couple of months after the other two cities' peak was in May of 22, and that's off 6.5%. But there's some. You want to talk us through the regionals, Ben?
Yeah, so in terms of New South Wales regional, we're seeing that its peak was in May of 22. It's off 2.8%. Regional Victoria, to Bryce's point earlier, it had a wonderful run, which finished in May of 2022, and that's now off 8.4%. Regional Queensland is setting its new peak. South Australia is setting its new peak. Western Australia is setting its new peak. And regional Tassie is off 4. Again, it also peaked in May of 2022. So we can see there that, this is, and to our point, we were, if you go back, wind back 18 months ago, we were concerned about the Hobart market and we thought it overshot itself. And that's corrected itself by 12.5%. It's interesting around the investor sentiment for Melbourne is actually quite positive because everyone thinks it's affordable. But on the other side of it, they're concerned about government interventions and the regulations and the taxes that are being charged here in Melbourne, similar to what we say about Canberra. So it's a real dichotomy of what's going on in terms of the debate in terms of how Melbourne will play itself out. But that just gives you a pretty good understanding in terms of where we are. And remembering that, if something's hitting its peak and then coming off its peak, then it's usually going to have a lull period for a period of time before it starts to move forward. And then you've got to start to ask yourself, well, what is the catalyst to re-engage that level of demand? And in some cases, it can be government incentives, such as first homeowners grants, or some types of tax concessions, which attract new demand to increase supply. Or in other cases, it's just the holding costs coming down. And the biggest lever of all is obviously interest rates, which we'll get to later on as well, as part of that story.
Ben, just the last thing on that, there's a reinforcing point there around generalised commentary doesn't necessarily tell the biggest picture because the combined capital since the onset of COVID has grown 34.1%, so 226,000. But there's such a range because if you go below that headline, Melbourne has done 9.9, which is 70,000 since then. And then the other end of the spectrum is Perth, which has done 74.6% since COVID, which is 340,000. So there's definitely a tale of different cities. But
and that 74 includes a decline of around 22 to 25%, Bryce. So it's recovered that and then grown another 50%. And that also bodes well for that whole story about you run a good economy, you attract new people into that market who can afford it. And it's obviously a very high income market over there. And you start to see that the price finding its level based on people who are able to afford that. And then we're going to see shortly about the rental story over there has been also incredible. And that's, again, a product of the higher wages that are over in that particular market.
And so one of the reasons we've had such price resilience is the fact that there's been an underpinning of stock, or more to the point, a lack of stock in a lot of areas. But we can finally see now that is starting to change a little bit, Ben.
Yeah, we are. So we've got a little chart up here, again, thanks to our good friends at CoreLogic. And what we're looking at here is the arrival of the spring listings. Okay, so what we've seen in terms of listings, they're 3.2% higher year on year. So 12 months rolling average, 3.2% higher. But then we start to think, well, what does that mean sort of over a more medium term? So over a 5-year period, they're 8.8% higher than the 5-year rolling average. So when we look at this particular chart, we'll explain it to our audio audience as well, the things that we're looking for is what's the arrival of new listings and then what are the total listings available to us. So we've seen since the 18th of August to the 22nd of September that there's arrival of 5.4% of new stock into the Sydney market, and that's up from negative 2.8%. 2.9% prior to that. So that's been a nice arrival of new stock. Melbourne's very similar, up 12.2% of new stock compared to only 6.3% of new stock arriving in August. And that's now meant that overall stock is around 12.8% higher overall. So that's a marketplace where we are starting to see, remember, supply is the enemy of capital growth. So that's what we're seeing there in terms of, higher supply. And so it's a great buying market. If you're looking for choice, there's plenty of choice out there. Brisbane's also, had a good spike of new arrivals. So 9.1% of new stock arriving into Brisbane in the last 4 weeks. And but even though that's arrived, the absorption's pretty strong. So there's only 0.8% higher. So you can still see that market's doing very well in absorbing that new stock. And that's why you get capital growth. And then this is the story of Perth. And this is why Perth has still potentially got a little bit more momentum in it. And that is because there's been a 2.4% increase in the last 4 weeks of new stock arriving, but still, in terms of where it was 12 months ago, it's still 18.3% below that line. Now, one could argue, well, was that line too high originally because it had been an underperforming market? Well, you could probably argue that if we're only in the start of the cycle, but because we've been in a long period of the cycle, it's still telling me that there is buyer appetite in that particular market. And I suspect that that's being led by both owner-occupier and investor now. So that's underpinning that particular story. And so that's a healthy story. In terms of Hobart, off a very low base, we can see that like Hobart has 333 new properties arrive for a total of 1,500 properties for sale. Now, for context, compare that to our biggest market of Sydney, it has 22,750 properties available for sale. And compare that to Melbourne, has 31,510 properties. So it's all relative. And that's also relative about the level of demand they get. If you actually have a look at Tasmania, they have got negative population growth at the moment. And that's always a risk when you've got an aging population down there and you've got slowing economy down there, then ultimately people are going to move to look for the jobs. And, that's also an underlying risk that I put in terms of a watch factor for Melbourne and Victoria, as that debt level gets high and the government has to basically lay off thousands upon thousands of workers and slow the economy down because we've got to repay debt. Where does that leave the job story? And so that is a watch and act based on that. At the moment, we're seeing still strong overall population growth into Victoria and especially into Melbourne. It's a very dynamic international city and lots of multiculturalism. So that bodes well for, the sentiment for confidence around property prices. But there is this underlying economic concern that I have for that particular market in the short term. Then we go, Bryce.
There's a lesson there too for our listeners around the voting machine and the weighing machine that we talk about, and I sort of hinted at the Mindset Minute, because you can see from if you are able to look at this, you can see that there is a real rebound in demand. And to your point around Hobart and Tasmania with that population, there was a period of time where everyone's saying let's be in Hobart, and if you were a part of the voting machine and you were part of a short-term cycle, you could have done really well. But now is where, to quote Warren Buffett, when the tide goes out, you see who's been swimming naked. The big question is, how sustainable was that growth over? If you're part of our philosophy, which is buy and hold for the long term, some of that gain is now being given back, and then the big question is what is going to be driving the any positive growth in that market in particular. Going forward. Now, there are pockets where people have done really well. We've had people come on the podcast and talk about that, but we are talking as a general rule where we're chasing, economic activity, lifestyle drivers, status throughout the eyes of our frameworks. I think there's a really good learning point there around, okay, there was a moment where Hobart was in the sun, but now it's all about that long-term sustainability and returning back to some of those fundamentals.
I love what you've just said there, Bryce. And if I can tell that story in terms of the state of Western Australia, exactly the same story. Running a surplus, passes the lifestyle, beautiful weather, great climate. You've got a government that's got, it's moving and diversifying away from mining more and more. It's got a competitive advantage in terms of its cost of energy and cost of gas. It's got a competitive advantage in terms of its access up into Asia. It's going to obviously be the central home for where our sub fleet is going to be based in terms of our nuclear sub. So there is a lot of diversification going on, and so that will attract workers into that particular market. So to your point, I see a 20, if well governed, and they govern for a growing economy, then Perth potentially could have a golden era of a change, because it's just got so many advantages. Because obviously its mining is also very diversified. It's got gold, it's got rare earths, it's got obviously iron ore, it's got the gas reserves, which is the transition fuel for the transition around climate change. So it actually has a lot of aces attached to itself. So that's why I'm reasonably confident about its medium to long term, because a lot of people talked about it like, well, it's a one-trick pony. If mining's underground, if mining goes down, everything suffers. Now, yes, a lot of industry is connected to that, but this is their opportunity. This is their chance to also be a high worth, high social, high living. All of those things can bode well for a broader dynamic economy in that particular market. So if I was the premier of that state, I'd be sitting there saying, great, I've got a strong economy, I've got surplus, so I can start investing in critical infrastructure, build another big hospital, like the main hospital that was recently built. I would be going all out in terms of building some of that great infrastructure that lets that city set up for the next 20 or 30 years. So that's an example that I would have. On the alternative, we're obviously seeing Darwin. It's in an economic decline. Its economy is underperforming significantly. There are a lot of restrictions and regulations around attracting new investment into that. So the new government going into Darwin is going to be very positive in terms of everything's about growing the economy and reducing restrictions and red tape and environmental red tape, so they can attract future investment into that. They've just announced a very, very significant first home buyers grant and incentive to get people buying and living in Darwin. So that in itself, means that they've got an opportunity, but they're coming from a long way back. And that's been the product of that economic growth and attracting new people in there. And that's why it's underperformed. And what Bryce showed you earlier, it peaked many, many years ago in terms of its higher price. But during the 2000 to 2010 period, Darwin was the best performing capital city in Australia, if my memory serves me correctly. And then you've got Canberra. It's a government town, high wages. Whenever the government's paying, everything costs more, and everything can be charged out more. But we always say it's not a place for us to invest, because they charge a 3 times premium for the holding cost and land tax. So we wouldn't be encouraging any investment, because all you're doing in that particular market is giving your money to the government. So it's not a market that we would say bodes well for passive long-term income off those particular properties. And that gives you a pretty good summary in terms of what that story looks like. All right, so let's now talk to that and break some of those things down. And so we are obviously, as we were saying at the start of the episode, we're really privileged around having all of this rich data available to us. So I'm going to switch over to our research platform, and I'm going to go down now and just sort of talk to some of the data that we have available to us. So I'm going to move down into some of the important things that you want to be looking at, which is days on market. So let's sort of bring up the days on market story here. And so I'm going to start with, I'll go from worst to best. So that'll sort of give you a bit of a sense of what's going on. So when we look at Darwin, we can see here that we've got this sort of days on market story that the reason why it's been underperforming is because there's still a long-term days on market average is 87 days on market. Now, we also look at, say, somewhere like Hobart, and you can see very clearly that it's trending in the wrong direction. So that means it's taking longer to sell those properties, which is clearly indicating there's not a lot of demand in that particular market. Let's look at Canberra, which we also saw underperform or lose a little bit of value. And you can see the trend for Canberra is also going in that same direction. So you can see this trend line going up. So now their average is 50 in terms of that. And let's now bring in Melbourne, and we can see in terms of Melbourne. Now, Melbourne's an interesting one because sorry, what have I done there? I've gone Brisbane, my bad. Let's look at Melbourne. So Melbourne's sort of flatlining, but the trend has been sort of down, but it's flatlining. So there's still there's still activity happening in Melbourne. I don't want to undersell it, but in terms of that line, the indicators are either flat and it's not sort of showing in the right direction. Now, when we then start to sort of compare that to the likes of the higher performing markets, let's start with Brisbane first. So we can see in terms of the Brisbane story, I'll take Canberra out, and you can see the trend is still quite strong in terms of, it's a strong line in terms of the days on market is certainly moving in the right direction, which means that it's not taking very long to sell those particular properties, which supports that underlying demand. Let's now bring in Adelaide. Similar type of story, but it is starting to sort of slow down, and that's that cooling moment. And then let's have a look at Perth. So I'll take Darwin out, and we'll have a look at Perth as a clearer story. You can see with the likes of Perth, that's a perfect chart for seeing exactly back in
trending. For those listening and not watching, it's trending down.
Yeah, and you can see here back in August of 2019, the average was 100 days on market. Now the average is 28 days on market across. Now that's the whole capital city of Perth in terms of all those markets. So that just gives you one bit of clue in terms of some of the core indicators that we're looking at. The second one I want to talk to you about is stock on market. So it's all well and good that they're selling quickly, but how much stock's arriving? Remember that supply is the enemy of demand. So we'll start again quickly with looking at, even though it's off a small base in terms of the number, the ratio, 1.6% of stock on market across all of Darwin. Now that doesn't seem like a lot, but it's a lot when you can compare it to the other markets. Let's look at Hobart. You can see it in the terms of our poor performing markets, and then also you can see Melbourne and that in terms of those particular areas. So Hobart's trending up, although there's been a little bit of a movement down in terms of stock, which we reported earlier. Melbourne's got that flat sort of story looking at there. But then let's go into the higher performing markets. We can see here Adelaide. There's a lovely graph that you want to have a look at in terms of that's being absorbed quickly and there's not a lot of new stock coming in. So that absorption rate is definitely where it needs to be for future capital growth. The same with Brisbane. So you can see there, comparing Adelaide to Brisbane. Brisbane is probably further in its cycle in terms of getting to, a more slowing and more balanced market. And then you bring in Perth and you can see, look at that story in terms of, where it's come from, and look at the challenge of stock. So effectively Perth has 0.7 of 1% of stock of available property for sale, listed for sale. But even Adelaide at 0.43 of 1% is incredibly tight markets. And that is boding well for what we've just been talking about in terms of that capital growth story. So I just find that it's really important that, when we start thinking about those particular stories, we can see them showing up in some of these core indicators. But we're starting to see, the part of the cycle where we don't know how long the tail is going to run for, or what's the next level of demand that's going to come through as part of that particular story, Bryce.
True. So I guess the next part of the supply story really comes down to the approvals market then. And you've got a scenario where your housing approvals, whilst they are trending up, are actually still below the decade average. And you've got the unit market also below that decade average, much more volatile, which you'd expect in that particular market. Currently trending up, but in terms of any comfort that anyone wants to have in terms of whether or not investment in property, residential property, is something they should consider, this graph really here gives you that baseline comfort, right? Because if you've got a scenario where there's not enough being built to cater the demand, you've got a federal government that's trying to hit a target that's 7-figure houses over a 5-year period that they're currently under run rate on.
Yeah.
We've used the analogy before. It's like having the bath tap on and it's spilling over the side. There's just not enough capacity for these people. So this is important for anyone for long-term property investing. And the question on whether or not, because we often get the criticism, Ben, you guys are always suggesting that you should be buying property. Yes, that's because we are long-term property investors. We're not timing property investors. So that's always going to be the case. But if you have a look at this data here, it's pretty compelling.
Yeah, and so let's think about what's living behind that data. Like, why are these approvals so sluggish? There's a couple of really critical things. One is we've got, around right across Australia, we've got this big infrastructure build that's going on from federal government into a lot of state areas. So that's taking a lot of construction workers. The government has failed dismally in attracting or recruiting tradespeople for whatever reason. One could argue union pressure. But for whatever reason, we should have attracted 50, 60,000 carpenters and plumbers and tilers and electricians and all of that. We have not done that. So even if we want to build some of this stock, we don't have the tradespeople to actually build it right now. So that bodes well for continued undersupply. And then finally, we've got an over-regulated local council, state government, and then federal in regards to sort of red tape around planning guidelines and that ability to actually build more in already established areas as opposed to building in greenfield areas that we heard Tim
Rewind the conversation with Tim 2 weeks ago.
Correct. So all of those are, and we've got to think about this as an investor, right? This is the business that we want to be in. So when we think about all of those, things that aren't easy to turn, aren't easy fixes, are going to take years upon years to potentially fix. It says to us that level of undersupply is going to be maintained whilst our population growth is going to continue to grow. So that bodes well for future capital growth, more broadly speaking, as part of that particular story. So, that's ultimately what we then look at is we'll come and have a look at the demand supply, ratio that we're seeing across all of our capital cities. So I'll just jump into that chart now. So we go up and have a look at our DSR, our demand supply, our pro, and let's have a look at, where we see some of those cities. So we'll start with Hobart, and we can see that, it's come off a reading. Now, what's a good reading? A good reading is sort of anything above 60 is where we would start to consider, broadly speaking, the 17 variables that we're looking at is showing us an indication that that market is potentially out of imbalance in terms of supply and demand. And so it's moved from August of 2019 at a reading of 60, and it's now down to a reading of 49. So it's very clear that that's got probably more oversupply pressure, and so that's got downward pressure on future price growth in that particular market. Let's have a look now at Darwin. We can see here in terms of that story still sitting at 49. So although this is a smoky for me, I'm predicting that at some point with incentives, the new government, your first home buyers coming in, and the yield story that we're going to see shortly, that this is a market that's going to be one to watch. But it is speculative. I wouldn't be buying in this particular market in my own personal name. It would probably be a self-managed super fund type investment for me. I'm not giving advice here. I'm just sort of saying what I would look at because it's spitting off cash at the moment. And so that's what I want my super to do.
That's probably an important point, Ben, because even though you say you're not giving advice, you've got influence, across this audience. So the point is you see that there might be some short-term volatility that you could be in favour of, but long-term you're also being very measured.
This is a cyclical play. Like, this is a market that I will get in and out of. So you know how we have the buy hold in our long-term weighing machine strategies. Because I only have to pay 10% capital gains on the sale, then technically if I can pick something up and it runs $250,000 or even higher, and then I can flip that property in, say, 3 or 4 years, considering it's cash flow positive pretty much with the yields that I'd be looking at. And I've done that sort of example in Cairns, and I've also done that in the Broome market. So where I'm now sort of looking at potentially exiting at least one of those markets as this new arrival of demand comes in, that's my time to tap out because I'm getting the bottom of the market and then trying to get that. So that's, again, personal strategy. It's not something that I'd be recommending.
A, it's personal. B, it's active, and C, it's not necessarily playing the weighing.
No.
The weighing.
The other 10 of my properties they're all long-term hold, right, in terms of what they look like. So, but you've got to make sure you're getting a bit of that balance of growth and income as part of that story. And so that's very much a speculative play. And again, it's my strategy. In terms of moving along from Darwin, we'll have a quick look at Melbourne. Now, the interesting thing about Melbourne is that's currently sitting at 64. So that says to us what we were talking before about when we look at those 17 variables, there is still enough activity in this particular market. So even though values are falling off, you can see it's been sitting around that 60 to 64 range over that sort of time period. So it needs something to either drive it forward or there's going to be something that will bring it back. And that's what we've got to be looking for in future data in terms of what that story tells us. Here's the Brisbane story. We can see it sitting at 59. So that's peaked at one point there at a nice strong 63. So we're basically seeing, that sort of taper off a little bit there. Then we've got Adelaide currently sitting at sort of 62. Again, had a really strong peak at 67. And then we've got the broader Perth market, and we can see that sitting currently at 60 as well in terms of, but that's still doing very well. But the reason why that number's down a little bit is we've got a variable in there called market cycle timing, and that's basically saying that it's probably at the back end of its cycle. So that's definitely bringing that score down a little bit at the moment in terms of what that looks like. In Canberra, we can see also sitting around that sort of 59, I think is the score there for Canberra. I'm just going to try and get it at 59. So you can see that's an aggregate market, and remembering we're not buying the capital city either. So this is a generalised sort of commentary, but it gives you a bit of flavour in terms of where each of those markets are currently at to sort of round out our story around demand and supply. Now what we want to do is we want to move across and start talking about the story that is the rental or the income story. So I touched on a little bit before with you in regards to Darwin, but we're just going to go up here and have a bit of a look at the sort of scenario that is the rental story. So we're going to start with vacancy rates. So let me jump back into the research platform and start playing around with vacancy rates. And what we can see here, and jump in any time, Bryce, let me just bring that up into a full screen. The vacancy rate story is quite incredible across all markets. So we'll quickly run through them. But we can see here Darwin, current vacancy rate of 0.67 of 1%. We look at Hobart, still quite strong at 0.85. So very tight rental markets there. Let's look at Melbourne. We can see that is easing off at 0.92. Now, my view on the Melbourne market has been changed on rental increases based on the 20,000 less rental international students that are coming into that market, because I've got to factor in that 20,000 rental students won't be coming into our apartments in the city area. And so that's definitely, in my mind, putting a downward pressure on rents in that Melbourne market. If all of those students were allowed to come before the federal government intervened to stop those students arriving, then there would have been even further pressure on rental values in the Melbourne market.
I think that's been underpinned too, Ben, by the fact that there's a ton of landlords that have actually, as per the rental bond lodgements actually dropping, would counteract that. So less people coming in, less properties on the market. So it's kind of been able to hide that a little bit.
Yeah, good point. Canberra seeing at 1%. Then we've got Brisbane. It's coming off its record lows, but a 0.67. And then we've got Adelaide also, you can see here, 0.61, super tight market. And then you've got Sydney, which is starting to be, a cooling in that particular market. Now, all this also bodes well for inflation, guys. Remember that inflation in terms of the basket of goods, from a property point of view or a housing point of view, rental inflation, which is still running way above where the RBA needs it to be. So I think it's in the sixes still. Late sixes, I think 6.9 from memory. So that along with input cost to build new homes is around 25% of the CPI basket of goods as part of the inflation story that we look at there. So that's one story. And then let's round it off with obviously the Perth story there. And we can see, I'm going to find Perth. Let me hover over Perth. There we go. Also super tight in the Perth market, where we can see it's now down to 0.63 as well. And that has resulted to the story that is, these rental increases. We can see here's the change in annual rents for houses. We can see there that Perth has been 10.8%, Adelaide 7.9%, Melbourne 6.4%, Sydney 6.4%, Hobart 5.7%, Brisbane 5.4%, Canberra 3.5%, and Darwin 2.2%. And those, feel very, very strong. But the surprise for me is really that Melbourne housing story. So I can make the argument for the unit market, but it's a little bit less easy to make that argument for international students moving into housing. So is that a combination of people regrouping and doing a lot more share housing to adjust for affordability as part of that story? I'm not quite sure in terms of what that particular story looks like. But then when we look at the rents for the unit market, we're also starting to see, like look at Perth, 11.7, again, off a really high income story there. Adelaide, 9.3, Melbourne, 6.6, Sydney, 5.2, Brisbane, 5.1, Hobart, 3.7, Darwin, 1.8, and Canberra, 1.8 as well. So good news for inflation, but I suspect that the increase in rents will continue to keep rising above the long-term inflation level as small business private rental accommodation providers continue to, they're currently subsidising the majority of their tenants. So I suspect that inflation will still, that annual increase will still remain elevated above that 4% in my mind for a reasonable period of time, given the shortage of rental accommodation that's currently available.
But the increase in the national rental index, Ben, that increased by just 0.1% over that September quarter. So that's the smallest change over a rolling 3-month period for 4 years. I think that's probably the important thing to note here. They're all strong. They're all very good. We're about to run through the rental yields, so you can see that there's a compelling case to be able to be a residential rental provider in this country. But the momentum is starting to sort of maybe look like it's getting to the peak across the country. And I think that's reflective of the fact that they've stopped letting as many people in at the border, Ben. And so I think that's important for us to acknowledge as well.
Yeah, I know. I couldn't agree more. And I think what we've also got to remember in terms of how you calculate gross rental yields is ultimately the value of the property and then the rent that's being received. So like look at Darwin at a 6.8% yield. That's been because, again, capital growth has been very sluggish in that particular market. So over time, rents have been able to keep increasing because the value hasn't. But if you get strong price growth and strong rental growth at the same time, the yields don't look like they're going anywhere, but they are still moving up in terms of the dollars that are being paid. So, you're seeing Perth here at 4.2%. So that's come off a long-term sort of 4.8. Even in some cases, you got 5% in some markets over there. So that's been a product of the 74% price growth that Bryce was talking about earlier. But you can still see, so Canberra 4.1, Darwin 6.8, Hobart 4.3, Perth 4.2, Adelaide 3.7, Brisbane 3.7, Melbourne 3.7, and Sydney 3%. And then the regions, do you want to run through the regions, Bryce?
Yeah, regional Northern Territory 7.3, regional Tas 4.4, regional WA 6%, SA 4.8, Queensland 4.5, regional Vic is 4.2, and regional New South Wales is 4.1. Hey, that yield of 3% for Sydney just kind of gives you a bit of an insight into on the ground anecdotal conversations that we're having with clients around. It's very difficult to buy into that particular market because when you're buying in 7-figure entry prices and you've got a 3% yield compared to where you can get yields across the country, even just across the border, you're getting closer to 4% over there in Brisbane. That kind of gives you a bit of an insight into that market. Lots of owner-occupiers, even the wealthy people who have big incomes are still finding it difficult for the outer pockets that come in that particular market.
Yeah, and a quick little reminder for the rookie players in this particular space, this is a really good education moment, and that is that the gross is not what you get, it's the net that you get. So you've got to look at your holding costs. And this is why we argue Canberra is shocking because you give all the holding costs away in land tax. But you're also starting to see, we've seen insurance premiums on property increase between 16 to say 23% in some particular markets. And now we've got insurance premiums that are factoring in climate change. So certain markets that are susceptible to major weather events of cyclones, heavy flooding, and those types of areas, you do need an extraordinary level of rental yield just to get to a net outcome because you're basically paying in higher costs. And that's something that a small business owner needs to understand, that it's all well and good that I'm taking higher revenue in at the top, but if my holding costs and operating costs are running my small business is continuing to keep growing, that whole story of getting that passive income to the bottom line when you retire is a really important story. So we've got to make sure, and this is the reason why we're going to be talking about negative gearing and capital gains tax exemptions next week, is that let's say they do ban it. That's another 30% cost base that's going to hit our bottom line. So all of a sudden, in terms of the risk-adjusted return, is it worth us in terms of even investing in this particular marketplace? So they're the types of stories that the government need to understand, because you won't have any supply of rental accommodation if you're not going. Well, those who stay in, they're going to have an incredible situation, right, where they're going to have so much demand for their business, for their accommodation, that they will be able to continue to ratchet it up. But it ultimately will be, that's not where we want to be. We don't want to have record levels of rent. We want to have the balance right, which is a good amount of supply, a good amount of stock, and then that capital growth and that rental income coming off in an open, free market operating, as opposed to a restricted or regulated market, and you get all these unintended consequences. Okay, so let's move along in terms of talking about this particular story. I want to have a look at, what does that story look like in terms of some of the key talking points, because we've talked a lot about a cooling market and what that looks like. Well, here's a great graphic coming in from our good friends at CoreLogic in terms of the number of markets that are cooling compared to those suburbs or markets that are growing. Do you want to take us through these numbers?
Just under 30%, Ben, at 29.2. So the national percentage of suburbs in quarterly decline is 29.2, which is interesting. But if you look at the detail, the majority of that's coming from Melbourne. Okay.
Yep.
Hobart, Darwin, and Canberra are around the 50. So Melbourne was at almost 80%. Hobart, Darwin, and Canberra are hovering around that either 51 to 54%. But then you go back to the darlings of the property market in Australia right now of Brisbane, Adelaide, and Perth. 3.8% Brisbane, 3.1% Adelaide, and 0.0% Ben in the old
not a suburb.
None.
Not a suburb in decline in Perth, in the Perth market. So that also, again, everyone sort of said Perth's got to stop at some point. Well, that data doesn't suggest it's ready to stop. That's sort of still telling us now the growth cycle is slowing.
Yeah, the momentum is slowing, but
the momentum is slowing. But exactly. So that's why I think that's a nice talking point. The other talking point that we also want to just continue to highlight when we lift our eyes from the here and now, the recent market, is we want to talk to this particular story, and this is the number of $1 million suburbs that are changing across the Australian market right now. And this is what we keep saying, is that eventually every suburb will eventually get to a median of $1 million, and then there'll be medians of 2 million and 3 million over the next several decades. So we saw some of the net changes going on here. So we saw in the Greater Sydney, another 46 suburbs moved into that median $1 million price range. Greater Brisbane's had again a great run off the back of this, a couple of years of strong growth that they've had. 46 suburbs joined that particular story. Perth, 36 suburbs joined. Regional Queensland also had 30 suburbs join, so that bodes well for Sunshine Coast, also Gold Coast, and some of those sort of really blue chip areas in some of those regional towns. Greater Adelaide, 29 suburbs joined, and then regional New South Wales, 22 suburbs joined, and then Australian Capital Territory, 6. Then you got Greater Melbourne, only 4 joined. And remember that 75% quartile and that mid-quartile, that's what's pushing that down. That's why we haven't had that. And then regional WA, only 1 extra suburb. And then regional Vic lost 2 out of that $1 million price median. But let's put that into context, Bryce. Let's just sort of give the audience a bit of an understanding of those broader numbers in terms of how many suburbs do we currently see where there's houses and units with a median price tag of $1 million or more.
Yeah, well, the in Sydney there's 448 suburbs with a current median above $1 million, and that's comparison to its next biggest capital city, which is Melbourne, which is less than half, so 191. Brisbane has 149, Adelaide 104, Perth has 96, and Hobart has 3. But those that rose above $1 million, Ben, in Sydney, there was another 37. So that's to the point that you were talking about earlier. And yeah, poor old Melbourne has the record of having 2 that fell below a million, whereas none of the other capitals had any that fell below.
And for a little bit of context there, like if you look at, so Sydney's suburb analysed, 572 suburbs, 448 of those have a median above 1 million.
80%.
And then you've got Melbourne, which 378 suburbs were analysed, and you've got 191. So you're getting back down, into still above 50%, but only just, right? And then you've got Brisbane sort of hovering around that 50% mark, and the same with Adelaide below 50%, and then Perth definitely below. And then this is the wealth of New South Wales. You've also got, of the 494 regional suburbs in New South Wales, 111 of them. So when you start thinking about that beautiful coastline, as you go up through Palm Beach and then into, all of that sort of lovely coastline heading up towards Newcastle and all that area through there, you've got some very, very wealthy areas, all coastal, beautiful infrastructure, long-term economic drivers into those regions, and that's why you've got 111 of those suburbs and
25 rose.
Yeah.
25 with 3 didn't, so that's a net 22 going into that bracket.
And I suspect that also thinking about the aging population who are downsizing out of the Sydney market to get to their retirement markets, that's going to bode well for those particular markets. It's unsustainable over the long term. We need those economic drivers. But if I'm downsizing, and I've got a bit of a spare cash, I'm going to whack that in the super, but I'm also going to buy myself $1 million property with ocean views, as part of that particular story. So that bodes well for a good story in terms of those talking points. The other thing that I wanted to just bring home in terms of the key takeaways, because I think it's now time that we sort of wrap up. The critical part here is, we've said it a couple of times throughout the course of the pod, and that is supply is the enemy of capital growth. All right. So whenever there's additional supply coming in, and if there's a lot of it in a quick succession, that's going to put downward pressure on growth in those particular markets. And broadly speaking, the momentum in the market and the undersupply will continue for at least the next 3 to 5 years. I can't see any quick fixes that any government's going to be able to deliver to us. So we're going to see a significant undersupply, which gives us good confidence over the shorter term of the next 5 to 10 years that we're going to see that continued capital growth, subject to the economies in those local areas continuing to grow. That's an important mechanism for making sure that value rolls through into residential property. We are definitely seeing that increase, in terms of where there's going to be pressure in those markets right now. So the Darwins, the Melbournes of this world, that's because of the poor economy, or a slowing economy, or an economy that's riddled in debt that we've got to look for.
Or an economy that's being interfered with.
Yeah, and then there's that sentiment story. And obviously we've been very, sort of anti-Melbourne and anti the government down here in terms, and that's definitely shifted sentiment around that particular market. And now that is going to be balanced up by boardless investors who are retail investors who are thinking medium to longer term, and they could, again, underpin that level of demand as they see really affordable land and improvements on that land down here in Melbourne and Victoria more broadly, the Geelongs of this world.
Well, it's a market cycle timing play, isn't it, really? Because if
Correct.
you've had all these markets that are going, getting all the headlines, and then you've had Melbourne that's coming off, and as we'll talk to this point shortly, but as you have a look around the corner and eye to what might be the next form of stimulation, which will be eventually some form of interest rate cut, and you've got choice in the Melbourne marketplace, I would be saying to folks that if you're coming off a lower base, there's evidence to suggest that the Melbourne marketplace is hitting some forms of bottom. If you combine that with choice, and then being in the asset selection lane with the eyes well and truly on what's probably going to happen in February or March of next year with respect to interest rates, that's I see that as a market cycle timing play.
Yeah, and I want to, in wrapping up, I want to congratulate those people who took action at the start of the year. Like, our February update, and we've obviously done one in August leading into the spring season. Those people took action, and I think they will be rewarded over the medium to longer term in terms of the action that they've taken. And I think if they have found themselves in our big economic engine markets of Sydney or Melbourne or wherever they are, they're going to do well. Those who have also gone into those affordable markets, they've had some wonderful gains in this current period of time. That's great for equity and potentially rinsing and repeating. And, I want to congratulate them as well, because they're feeling pretty good about the investments that they've made over that medium to longer term. Those cities have still got to keep reinventing themselves. They've still got to be an attraction city to bring that population in. They've got to still keep that economic flywheel growing. And if they don't, those markets will again continue to subside and bottom out and stagnant for decades if they don't do the right thing from an economic point of view. And then, what we have seen is, because these interest rates have remained higher for longer, which I mentioned earlier in the start of this update, it has allowed this window to open up even further, where we are definitely, to your point, Bryce, in what we would call a buyer's market rather than a seller's market in some of those markets like Melbourne, and some of our regional markets around Melbourne. And I think what we've then got to say to ourselves is, from a logical point of view, we just do the 5 whys. It's like, okay, well, what are the things that are going to increase the next level of demand? Well, the next level of demand is going to come predominantly from an interest rate cut, to your point, Bryce. And so the why is, and if we look at, we did see where Evan and I did the update last week, we saw the inflation data drop the day after. So I just wanted to quickly talk to that. So we're seeing the monthly inflation figure fall to 2.7. We've seen the, excluding the volatile items, it fall to 3. And then we're seeing the annual trim mean fall to 3.4. Now, it's the trim mean one that's the most important. And that's not in the band of 2 to 3%. And remember that Governor Bullock was basically talking about this idea that sustained. She used that word a lot in the media conference post that
energy rebates don't count, mate. That's not sustainable.
No, that's not sustainable. She will disregard the government rebates on energy, which has manufactured some of that fall. But all of the other indicators, again, are still moving in the right direction. But that's sustained story. So then we look at the 30-day intraday bank, and we're definitely seeing that there's an expectation that come February, the money markets are pricing in at least one rate cut by then. Now, if I was a betting man, I would say that the governor, being the conservative governor that she is, and the board, that they wouldn't be looking at a December rate cut and stimulating the economy and risking that sustained inflation staying high, because we get out there and spend because we all get a little bit of extra money come these rate cuts. But certainly February, March, when we get probably the December quarter inflation read, if we get 2 of those quarters showing that trim mean is now within that band, remembering that there's a significant lag in terms of when you do drop the cash rate, it takes a while for that to improve supply of cash in the economy, the same way as it takes a while when you increase interest rates to put the brakes on and to slow that economic flywheel. So, that's an important story for me, is when I'm thinking about this little window that's being open, and this is sort of my what's making property news outside of the negative gearing story for next week, is that you do have that window. So if you're serious about owner-occupied purchase, or you're serious about upgrading, or whatever it is, you want to try and do that with the least amount of competition possible in some of those markets. So be counter-cyclical in those particular markets. You're still not going to be able to achieve that in Adelaide, Brisbane, or Perth, but think about what might happen even in those markets when you are looking to upgrade or downsize from an owner-occupied home, or if you're looking to invest in those markets. It's pretty clear that if we get a couple of rate cuts in the first half of next year, then you would logically think that would lead to a further increase in the level of demand that is then starting to look for property.
Yeah, well said, Ben. All right, so that's a fair wrap that we've covered there. Hopefully that's helped you folks. So there's clearly a bit to digest there. The headlines of this, there's momentum that's coming out of the property prices. There's momentum that's coming out of the rental prices, but ultimately we see that there's because people have household pressure, pressure on budgets, all those sorts of things, and for interest rates being held higher for longer, there is this little opportunity as we come into the shadows of Christmas, and as we come out of the shadows of Christmas on the other side, to think about what that might look like for the property market. So good wrap there, Ben. I think hopefully that's helped some folks who are wondering what they should be doing for the next little part of the cycle. And obviously, probably the next chance that we'll have to analyse it to this level of detail will come early in the new year. So, any final thoughts, mate?
Well, I just think that, yes, we could probably, depending on what happens in November with the cash rate, we'll talk to that in our general show. But to
Yeah.
your point, we won't be doing a deep dive. We will set up for another sort of outlook episode in February, which will give us that particular impetus to see where we're at and what's been absorbed over that Christmas New Year period. So I think that's well said. So, yeah, this is your window, guys. In terms of thinking about the market and starting to research. Even if you don't act, I want you to act in terms of doing your research and start looking, get an idea of where price movement is at. It does take several months to potentially get into the market if you're doing it manually by yourself instead of engaging a professional who's been in the market and knows what's going on from a day-to-day point of view. So if you're going to be doing that, start working on it now. Start doing your due diligence now. Start trending and tracking some of those markets. Start looking at certain properties that you might look to buy. What did they sell for, et cetera, et cetera. And that'll keep you in good stead to know where it finishes up this year, or you might get a buying opportunity that you didn't expect because that vendor becomes a motivated vendor and they come back to you and offer you, or you offer them a great price and you snag a bargain. But on the other side of that, if interest rates rise in February or March, just remember that it can turn in a week. The property market can turn in a week off the back of an interest rate story because that's a sentiment shift, and that sentiment shift will bring activity along with it.
Well said. As we sort of now change our focus towards negative gearing, we'll just remind everyone next week we're going to cover that in a fair bit of detail. So stick around and tell your friends about that live opportunity if you want to be a part of that. Hey, my life hack today, Ben, it's regarding a reel. There's an account that I follow called the Dinner Table Family. I really like some of the messages. Have a little listen to this as our team cuts to it.
This 11-year-old kid will be a millionaire before he's 18. So I was coaching a group of kids the other day, and what I told them was, if you want to create the most value and be financially successful and successful in relationships, find the biggest problems that you can possibly think of to solve and solve them. And the more and more problems you solve, the better you get at it. And so one of the kids in the neighborhood, he's like, oh, well, there's a problem with all the water softeners in our neighborhood. I'm going to go figure out a way to put salt in the water softeners. So he goes to Walmart, he buys $2 salt bags, and he goes to these doors of the neighbors, and he's like, for $15 a month, I will come to your house, pour the salt in your water softener, and do that every single month, because every 3 months you need 3 bags, so I'll just do it every month. And they'll pay him $15. This kid already has 1,000 customers. He's like 11. All he did was he found a problem and he solved the problem, and he's crushing it. And no one says no to children, so he's got a great business. And this is the point. If we teach our kids to solve more and more problems every day, and you'll have a great life.
So I really love that, Ben, because what it was saying is there was a family that says to their kids, and this is probably a message for anyone who's a parent, but also anyone in life in general, let's be honest. If you want to create the most value and be financially successful, find the biggest problems that you can possibly think to solve and solve them. So here you've got this 11-year-old kid who was being mentored into go and find more problems, and the more and more problems that you solve, the better you'll get at it. So he just sort of said, well, in my neighborhood, there's a challenge with the water softener, so I'm going to figure a way to put salt in the water softeners. Went to Walmart, obviously it's American here, got $2 salt bags, and then went to the neighbors and said, every month I'll put, if you pay me $15 a month, I'll put salt in your softeners every month. Guess what, Ben? 1,000 customers, and he's 11. 1,000 customers, and he's 11. So all he did was find a problem and solve it. And no one says no to children, so it's obviously got a really great business. So here's the life hack. Teach your kids to solve more problems every day, and they'll have a great life. And that particular kid's probably going to be a millionaire by the time he's 18. Find problems.
Love it.
Bigger the problems that you can solve, the more that you will give value to people, and ultimately, it probably, like this kid, will end up being very financially rewarding for you. So there you go, Ben. Something for the parents, but just people in life who are breathing, Ben.
Anyone who's aspiring, that's what you do. You solve problems, and with solving problems comes value your way.
Yeah, value creation. That's how you create value. So thinking about thin end. Start with small problems. Teach them to get a run rate on what's bigger problems. Ben, from this particular family, I'm now asking my kids all the time, what value did you create today? And sometimes they look at me and go, oh, here we go again. I said, boys, it doesn't have to be big. Doesn't have to be big. Just tell me some form. And then they're starting to think about it. So this is the next one that I'm going to plant the seed.
Beautiful.
What problems can you solve and how can you solve them? Hey, what's making property news is usually the throw at this point. You've already covered that in extensive detail, other than to just remind folks that what is making property news, the biggest news story in town right now is negative gearing. And we are definitely going to be covering that next week, as we've said a couple of times now. So, mate, always a pleasure. Always nice to go around the grounds. Always nice to give our audience some data to back up some of the noise that people can often hear. But until next week.
Knowledge is empowering, but only if you act on it.
See you next week, folks.